Hello, my name is Benjamin Tan, and I'm the Securities and Education course, i.e. the SEC co-lead lecturer. SEC is student-led course run by the Investment Society, and welcome to the SEC Winter Special, which is the 20-minute condensed bite-sized version of the lecture for you to brush up on your knowledge in the winter holiday.
Hello, my name is Sebastian Stewart, and I'm the co-lead lecturer along with Ben. The SEC is a finance lecture series based on the CFA Level 1, covering a range of topics ranging from equities to real estate to FX and many more. This lecture series is ideal for beginners as well as advanced and intermediate students. We hope you enjoy listening to the podcast as much as we enjoyed delivering the lectures. Thank you for all those who attended the course this year. We had a record level of registration and hope to welcome more of you next year.
Welcome to the SEC Winter Break Special. My name is Alia, your co-host for IIIP, and I'll be giving the Derivatives 1 lecture. Today we're setting the stage for an exciting dive into the world of derivatives, a financial tool so intricate and fascinating that it deserves its own episode. But one housekeeping note. Before we dive into the world of derivatives, let's clear the air. Derivatives, at first glance, can seem like the financial world's most abstract, off-putting concept. But here's the secret. Once you understand why we need derivatives, everything starts to click. So here's our approach. We'll start with the why before we even touch the what. Today we're keeping it simple, covering the basics, because derivatives can get pretty math heavy when you dig into the advanced stuff. But don't worry, we'll save that for another time. So here's a phrase you'll want to remember. If there's money to be made, anything can be arranged. When you find yourself asking, why on earth would anyone agree to a deal like this? That's your answer. Someone, somewhere, sees an opportunity to win. You've already got the foundation in earlier lectures. What financial markets are about, who the players are, and what drives the daily hustle. But at the core of it all, the goal is simple. Make as much money as possible while risking as little capital as necessary. It's a game of strategy, where every investment carries the chance of reward and, yes, the risk of loss. Because let's face it, whether it's an economic downturn or a freak environmental disaster, uncertainty is always in the mix. Before we can dive deeper into derivatives, we need to play the groundwork for some key terms, especially those tied to risk. Let's start simple. Risk is the chance of something going wrong. It's measured in two ways. How likely is that to happen, and how severe the outcome will be. Take a homeowner defaulting on their mortgage, for example. To reduce risk, banks check credit history to ensure borrowers can repay. But if they default and the housing market crashes, the bank may lose money on the loan. This kind of scenario played a huge role in the 2008 financial crisis, when banks issued risky loans to people without income, jobs, or assets, ninja loans. Unsurprisingly, many borrowers couldn't pay them back. Now let's talk about business deals. Every deal has two sides, a buyer and a seller, also known as counterparties. Your counterparty is simply the person or entity on the other side of the transaction. Why does this matter? Enter counterparty risk, the chance that your counterparty won't hold up their end of the deal. This risk is a major driving force behind the existence of derivatives. Then there's hedging, which is essentially a safety net. Think of airlines locking in today's fuel prices for next year to avoid paying more if prices spike. Now, when you invest in something, you take on exposure, the amount of capital at risk if something goes south. Buying a house for £1 million, your exposure is £1 million. And yes, exposure can exceed what you initially pay, especially in markets like commodities. Finally, let's touch on the spot price. This is what you'd pay to buy an asset immediately. For example, Tesla stock might have a spot price of $622 right now. It's simply set by supply and demand isn't a key factor in determining derivative prices, as we'll learn later. These concepts are just the tip of the iceberg, but they're crucial for understanding the world of derivatives. Lovely. So we all know by now, every investment comes with an intrinsic risk. But the big question is, how do we protect ourselves from those risks? How do we hedge against potential losses and minimize exposure to capital losses when things go south? Here's where derivatives step into the spotlight. Now, you've probably heard the term tossed around in financial circles. But what exactly are derivatives, and why are they so important? In simple terms, derivatives are specialized financial contracts. Their job? To help hedge risk. Think of them as a safety net that minimizes your exposure to potential losses. These contracts are designed with specific mechanisms that let investors manage uncertainty in markets. And now an important side note. In mathematics, a derivative measures the rate of change. In finance, derivatives measure and manage risk. They're totally different concepts, but the shared name comes from their underlying similarity, change in control. To put simply, a derivative is just a contract whose value is tied to something called an underlying asset. The underlying asset, often shortened TUL, is where things get interesting. It could be anything: stocks, bonds, interest rates, or even weather conditions. Here's a relatable example. Think sports betting. If Arsenal plays Manchester United on Sunday, bookmakers might offer odds based on the predictions of the game's result. Those odds are derived from the expected outcome. Much like a derivative's value comes from its underlying asset. While sports bets and financial derivatives have distinct purposes, the underlying logic of basing a contract's value on something else is the same. Now, derivatives aren't just for hedging risk. They can be used for speculating, which is essentially betting that an asset's price will go up or down in the future. This flexibility is what makes derivatives so powerful and widely used. Lastly, the beauty of derivatives lies in their variety. These contracts allow investors to manage risk in ways that suit their specific needs. The specifics of how they work, we'll get to that later. But for now, just remember, derivatives are all about managing risk. There are several types of derivatives that you will come across if you choose to work in financial markets. We'll only be covering a few of them in this lecture. Stay tuned for lecture 2. But these derivative types are futures, forwards, options, and swaps. And now, a brief aside about shorting. You've likely heard the term selling and shorting used interchangeably, but they're not the same. Selling is simple. You sell something you own. Shorting, however, is more strategic and risky. Here's how it works. You borrow an asset, sell it for cash, and hope its price drops. Later, you buy it back at a lower price, returning it to the lender and keeping the difference. For example, if you borrow a $100 stock, sell it, and then buy it back at $90, you made $10. To short, you only need a small margin, especially a security deposit. This margin allows you to leverage your trade, amplifying both potential gains and losses. For example, putting down $10 could give you an exposure to $100 worth of stock movements. Shorting is common in FX trading, used for both hedging and speculation. It's a powerful tool, but one that requires a careful eye on the risks. Let's break down two of the simplest types of derivatives, futures and forwards. Both are contracts that let you buy or sell a specific amount of an underlying asset at a set price at a future date, known as the expiry or settlement date. The key difference? Futures are traded on exchanges and open to anyone, while forwards are private deals, usually reserved for institutional investors working directly with banks. What this means is forwards are traded over the counter, OTC, and futures are traded on an exchange. Here's how they work. Imagine agreeing to buy 100 barrels of oil for 100 each, 3 months from now. Whether the market price rises or falls, both parties are locked into the agreed price. One party takes a long position, meaning to buy, and the other takes a short position, meaning to sell. These contracts are widely used to hedge risk or speculate on price movements. For example, in the aviation industry, airlines often use forwards to lock in today's jet fuel price for future delivery, avoiding the risks of price spikes or impracticality of storing fuel. Traders also prefer futures and forwards to buying physical assets, as they can profit from price changes without needing to take delivery of the underlying asset. Some contracts even allow for cash settlement, where you settle the difference in price without handling the asset yourself. Whether you're mitigating risk or leveraging market movements, futures and forwards are essential tools in modern finance. Let's start with a trading system you might already recognize, exchange trading. In exchange-traded markets, standardization is the name of the game. Here, derivatives exchanges like the CME Group provide a platform where contracts have predefined terms. Everyone trades the same type of standardized contracts. For example, a future contract might represent 1,000 barrels of oil expiring in September or October. The standardization ensures liquidity. In other words, it's easy to buy or sell these contracts because there are a lot of traders dealing with the same product. It's a far cry from the earlier days of trading where farmers and merchants would negotiate over any quantity of grain, from 1 to 70 tons. Standardization solves this problem, creating a more consistent and efficient market. One of the first derivative exchanges, the Chicago Board of Trade, was founded in 1848 to bring farmers and merchants together. They introduced the to-arrive contract, an earlier version of today's futures, to schedule delivery of standardized grain quantities. While the CBOT no longer exists, it laid the foundation for modern exchanges, eventually merging into the CME Group, now the world's largest derivatives market. Here's how the exchange works today. While two traders agree on a deal, it's handled by the clearinghouse. The clearinghouse acts as a middleman, managing the risk for both sides. This means traders don't need to worry about whether the other party can fulfill their end of the deal. To ensure this, the clearinghouse requires each trader to put up a margin, a set amount of collateral used to cover any losses if the trade goes against them. With standardization, liquidity, and the security of a clearinghouse, exchange-traded futures offer a structured, reliable way to manage risk or speculate on price movements in global markets. Now let's explore over-the-counter markets, or OTC for short. Unlike exchange-traded markets, OTC markets operate behind the scenes, and unless you're working in finance, you won't see them in action. These markets are dominated by major players like banks, large financial institutions, fund managers, and corporations, and they deal primarily with bespoke financial products, customized contracts tailored to the needs of the buyer and the seller. Here's how it works. Imagine a hedge fund wants to speculate on the price of gold. They'll contact their trader at the bank directly, traditionally by phone or email, and get a quote for a forward contract. The trader will provide two prices, the bid and the offer. Banks often act as market makers, setting prices and ensuring there's always a buyer or seller for popular instruments. Once the deal is agreed upon, the trade can be settled in one or two ways. Through a central counterparty, CCP, the CCP acts as an intermediary, standing between the two parties and eliminating risk of one side defaulting, or a bilateral clearing. Here, two parties deal directly with each other. They typically sign an agreement outlining the collateral requirements and the terms under which the trades can be terminated. OTC markets provide unparalleled flexibility and customization, making them essential for complex financial strategies. But with this flexibility comes less standardization and more reliance on relationships and agreements between parties involved. So you might be curious, how big are these markets? The short answer, huge. Let's break it down. For the over-the-counter derivatives, the value of the underlying assets is staggering. For instance, a typical OTC agreement might involve buying 100 million worth of US dollars with euros. But here's the catch, only 1 to 2% of that amount actually changes hands. Instead, cash flows are netted out, and the only profit or loss is transferred between the traders. When it comes to trading volume, exchange-traded derivatives far outnumber OTC trades. This makes sense. Exchange trading is fast, electronic, and efficient, unlike OTC trading, which often requires phone calls or emails to arrange bespoke products. But here's the twist. The average size of the OTC trade dwarfs that of an exchange-traded. OTC markets handle deals worth tens of millions or even billions of dollars, making them far larger in terms of total market value. Just to give you an idea, the underlying principal of the OTC derivatives market today is estimated to exceed 1 quadrillion. This explosion in derivative trading has shaped modern finance, although it has also brought risk, as seen during the 2008 financial crisis when the dangers of leveraged derivatives became clear. The main reason for huge success of the derivatives market includes the ability to traders to access large amounts of liquidity, as well as the wide range of different payoffs that can be synthesized with just one underlying asset. So whether it's the OTC or exchange-traded derivatives, the sheer scale of these markets is a testament to their central role in global finance. Returning back to the settlement of these trades, imagine if every time you entered a derivatives contract, you had to take the delivery of the underlying asset. For most traders, this would be a logistical nightmare. Case in point, a junior trader at an investment bank once forgot to sell a forward contract for cattle, and yes, they had to leave the office to sort out actual cows. To avoid scenarios like this, there are ways to trade derivatives without dealing with physical delivery. One is offsetting contracts. Traders can close their positions by entering an equal but opposite contract. For example, if a trade is long on 1,000 ounces of gold, they can close the trade with a short contract for the same amount. Second is cash settlement. This method skips delivery entirely. Instead of exchanging the underlying asset, the profit or loss is settled in cash. Cash settlement is common in exchange-traded futures and allows for quicker trade and increased market liquidity. By using these mechanisms, traders can focus on the financial benefits of derivatives without the complication of handling physical assets. With that, you're ready to explore how the payoff characteristics of these contracts work in practice. Let's talk about payoffs, a key concept in derivatives. A payoff represents the profit or loss an investor realizes from the position in a futures or forward contract. From these contracts, payoffs have a linear characteristic. Essentially, they form a straight line when plotted. Here's the basic formula for a long position. Payoff, P, is equal to the spot price, S, minus the delivery price, K. If the spot price at maturity is higher than the delivery price, the investor profits. For a short position, it's the opposite. Since forward contracts cost nothing to enter, the payoff directly reflects the total profit or loss. Whether cash settled or delivered, the math stays the same. Simple yet crucial for understanding how these contracts work in practice. If you're near a paper or pencil, this is a great moment to try something hands-on. Let's sketch out the payoff structure of a forward contract. This will help you truly visualize how these contracts work. First, let's draw a simple XY axis. Label the horizontal axis S for spot price of the asset at contract maturity, and vertical axis P for payoff. Place K, the delivery price, on the horizontal axis as a fixed point. Now let's focus on the long position. Draw a diagonal line starting below the horizontal axis and passing through K, sloping upward. This line represents your payoff as the spot price increases above the delivery price. If the spot price is higher than K, you profit. If it's lower, you incur a loss. Now let's look at a short position. Draw another diagonal line, but this time sloping downward from above the horizontal axis and passing through K. Here your payoff decreases as the spot price rises, meaning your profit when the price drops below K and lose when it rises above. These straight lines highlight the linear payoff characteristics of forward contracts. A profit or loss moves directly with the difference between the spot price and the delivery price. Take a moment to label your graph. You'll see how simple, yet effective, this visualization can be in understanding forward payoffs. Again, a note, payoffs differ between types of derivatives. The above was an illustration of only forwards and futures. Now we've covered how futures and forwards work. Let's tackle the big question. How are they priced? At the core of pricing is the spot price of an underlying asset, the price of an asset at the time the contract is entered. This is the single most important factor. Beyond the spot price, several other elements influence the cost of futures contracts, including interest rates, dividend income, storage costs, for example, for physical goods like oil or grain, the risk-free rate, which is the theoretical return on investment with zero risk, think government bonds, and convenience yield, which is a premium for holding physical inventory rather than a contract. These factors come into play differently depending on the type of the underlying asset. For example, oil futures will account for storage costs, while equity futures may incorporate expected dividend payouts. Futures contracts are typically quoted in specific units, like cents per a pound of cattle or dollars per barrel of oil, contract size reflecting multiples of these units. For example, a cattle futures contract may specify 40,000 pounds of cattle, where an oil futures contract could cover 1,000 barrels of oil. Understanding how these elements interact is crucial to grasping the mechanics of derivative pricing. Before diving into how futures delivery prices are calculated, let's explore why factors influence the price paid for a futures contract. At its core, future pricing, like much of the market, is driven by one simple principle, the principle of supply and demand. The price you see on exchange represents the highest bid someone is willing to pay, but factors like interest rates, storage costs, and dividends affect the price because markets are highly efficient at eliminating arbitrage opportunities. Although we've touched on this in previous lectures, it's worth repeating again. What is arbitrage? In finance, it's the process of finding riskless profit. Maybe you're thinking to yourself, okay, markets are good at eliminating arbitrage, but maybe I could find something. Unfortunately, in today's markets, algorithmic trading systems spot and act on these discrepancies faster than any human could. This ensures that prices quickly align, leaving little room for arbitrage. The same logic applies to futures. Factors like interest rates or storage costs impact prices because the market works to maintain balance and prevent guaranteed profits across different scenarios. This efficiency ensures that future prices reflect the true cost of holding or delivering an asset over time. Understanding this foundation is key as we move into calculating delivery prices for futures. In this episode, we enter the world of derivatives, focusing on two fundamental contracts, futures and forwards. These tools provide powerful ways to hedge risk, speculate on price movement, and manage uncertainty in financial markets. We began by understanding the mechanics of futures and forwards, agreements to buy or sell an underlying asset at a predetermined price or on a set date. While futures are standardized and traded on exchange, offering liquidity and transparency, forwards are bespoke contracts tailored for institutional investors in OTC markets. Next, we explored how these contracts are used in real-world scenarios, from airlines locking in fuel prices to traders leveraging contracts for financial gain. We also discussed the critical concepts like payoff, which represent the profit or loss from a position, and pricing factors like spot prices, interest rates, and storage costs, all of which influence the cost of a contract. Finally, we touched on the importance of market efficiency in eliminating arbitrage opportunities and ensuring that derivative prices reflect the true cost of holding or delivering an asset. To conclude, this lecture was a whirlwind tour around the world of derivatives. The mechanics, as into the pricing and the equations used, are much more complicated. For that, I highly encourage you come to the SEC course where we dive into this, or look up some YouTube videos. But by understanding their mechanics, pricing, and applications, you gain a clear picture of how the financial world operates. Join us next time as we explore further into the world of derivatives and go over swaps and options. Thank you once again for listening, and I hope you're having an amazing break. Credit to our producers, Alia Friedman, Louis Kim. Head of Marketing, Samhat Raman, Juniors, Ken Zhang, Angie Zhao. Head of Scriptwriting, Alfred Choi, Juniors, Aditya Muthakumar, Con Lin. Head Liaison, Lucrezia Poloni, Jr., Ekaterina Vitor. Head of Audio, Isaac Chu, Jr., Cyrus Lee. Head of Sponsorship, Sami Liu and Vladimir Dmitriev. Juniors, Leo Lee, Jamila Tabet, Utkarsh Jetli.